Good afternoon, everyone. We're Deering Capital, and we're excited to present debt restructuring opportunities for Kenwood Center. A brief overview of our team. Deering has put together 6 of our most seasoned professionals to provide optimal real estate investment advice. We'll begin with an introduction of our core strategy, our 3-pronged approach, the current situation, and our investment recommendation. Next, we'll walk you through a strategy overview of the Kenwood Center. We will then walk you through 4 distinct investment options and how we reached our ultimate recommendation. We will conclude with future investment strategy for the fund. As you know, Oakwood's debt fund is a value-focused fund with 50% of capital deployed. The target return is 9%, and the fully extended fund maturity provides 5.5 years of remaining fund life. We took these factors into consideration throughout our analysis. Now, this slide shows our proprietary investment strategy that guides every decision we make at Deering Capital. First, we look for markets that have high barriers to entry, strong demographics, and growing populations. Second, we look for assets within those markets that have prime locations, high-quality construction, and strong in-place cash flow. And third, especially in a debt scenario, we dive into sponsorship. We want to see our operating partners that have local market expertise in product type, a business plan we can get behind, and a proven track record. These 3 pillars, especially in a debt scenario, all contribute to downside protection. The current situation surrounds Oakwood's $20 million mezzanine position at Kenwood Center, a Class A retail power center. The borrower reached out to Kenwood because there are 6 months left before maturity, and the asset has faced significant challenges. 3 tenant bankruptcies have resulted in the center going from 95% occupancy to 75% occupancy, and NOI has fallen 40%, which can no longer service the in-place debt. As you can see from the table on the right, the current depressed cash flow is at risk of seriously impairing Oakwood's position in this asset. The sponsor reached out to Oakwood with a proposal of $6 million to invest in the form of further additional mezzanine debt to reposition the center and release it. We evaluated this along with 3 additional options and ultimately decided that the best recommendation would be to take the $6 million and structure it as preferred equity instead of additional debt. Again, please forgive the mismatched headings. We are advocating for an Oakwood modified proposal. Katie will now walk you through the strategy overview.
Thanks, Brian. I now want to talk to you about the market and why it has strong demographics, a growing population, and barriers to entry. First of all, we've all read the headlines. Retail is dying, malls are doomed, we have a retail apocalypse on our hands. But here's the reality. The reality is that that's just hype. In fact, total retail sales, excluding e-commerce, are growing to the tune of 3.1% year over year. We're seeing a real shift within retail as e-commerce giants like Amazon dive into traditional brick and mortar through the recent acquisition of Whole Foods. And then also these traditional brick and mortar retailers double down on their e-commerce efforts. And the numbers show really back up this omni-channel strategy. In fact, retailers who do it reported a 36% increase in sales year over year. So where do we see opportunity within retail? Power centers, specifically power centers like Kenwood. Power centers have low vacancy rates and low cap rates. What this tells us is that investors place emphasis and value on power centers, credit tenants, and predictable cash flows. Looking to the Kenwood market, we know that it has barriers to entry, and we also know that household growth is expected to rise 7.7% through 2021. Not only that, but the area's low cost of living shows us that residents there have considerable disposable income to spend at areas and centers like Kenwood Center. I now want to talk to you about why Kenwood Center is specifically a power center that we're interested in. Right now, the vacancy rate stands at 25%, but we are confident in the sponsor's plan to turn this around, and Raul will tell you more about that later. For the remaining 75%, we used our proprietary analysis and found that a full 80% had an overall corporate outlook that we see as strong. While we acknowledge that there are key trends within retail moving towards experiential and lifestyle centers, ultimately, we as the debt holders think that these are too risky of strategies to propose as ways that we can get back in the money. Instead, we agree with the sponsor's plan to turn this into a daily convenience center and really think that this is the clearest path to value moving forward. Now, Raul will tell you more about the sponsor's plan.
Thanks, Katie. The daily destination strategy focuses on attracting tenants who will complement the existing tenants in home, health and beauty, and food and beverage. Complementary tenants were evaluated based on performance, innovation and growth, and space needs. The following target tenants meet these criteria and have already shown an interest in the sponsor strategy. For home, the sponsor plans to complement existing tenants in furnishings and electronics and will bring a hardware store like Ace Hardware to the mix. In health and beauty, the sponsor plans to complement the existing cosmetics and service tenants by adding a fitness center like Planet Fitness and urgent care like MedExpress. In food and beverage, the sponsor plans to complement the existing fast casual restaurants by adding Asian cuisine like Pei Wei and also adding a package store like Total Wine & More, which will fulfill an unmet need within the submarket. Finally, the sponsor plans to add value to the center by attracting a grocery anchor. Both Trader Joe's and rapidly expanding Lidl are attractive targets. In execution of the sponsor's lease-up strategy achieves 95% occupancy and creates a true destination in home, health and beauty, and food and beverage. Kenwood Center's exposure to risky tenants is greatly reduced, and the final mix consists of tenants which are Amazon-resistant, cohesive, and drive traffic. I'd like to quickly address the situation with Toys R Us, who has requested a 40% reduction from the sponsor. As the debt holders, we recommend mitigating the risk of a potential increase in vacancy of 25% by approving this request and preserving the in-place cash flow. Additionally, if Toys R Us ultimately vacates the space, we believe it can be quickly reabsorbed by Planet Fitness, which would also honor outstanding co-tenancy agreements. Next, we evaluated the sponsor. We believe MacArthur Properties is the best operating partner for Kenwood Center because they were the original developer of the site. They have long-term relationships with retail tenants in the market, and they are a fully integrated operator. They also have a vested interest in preserving the value of 12 undeveloped parcels adjacent to the site. However, we also recognize that MacArthur Properties has limited equity in the deal and non-recourse debt. So we must align incentives to ensure the sponsor executes the outlined strategy and not a riskier one. I'm going to pass it off to Alex, who will go through the investment evaluation.
Thank you, Raul. So I'm going to start by qualitatively walking you through how we assess the 4 options available to Oakwood, and then we're going to dig a bit further into the numbers. So to start, we looked at providing an additional $6 million of funding in the form of mezzanine debt. We find this to be risky in that the borrower has limited equity in the deal and non-recourse debt, and while we do believe in his vision, we want to make sure he sticks to this vision. We don't think we'll have that control right in the form of mezzanine debt. Therefore, we're going to counter in the form of preferred equity, because we think this gives us the seat at the table that we require to make sure he sticks to this business plan. We also looked at 2 scenarios around foreclosure, the first being selling the asset today. This really risks that it is 75% leased, and we could be leaving a lot of value on the table. The last is foreclosing and holding this asset and bringing in a new 4-fee operator. And while we acknowledge this is an option if we're unable to secure preferred equity, we do think the current borrower is the best at executing this business plan, given his relationships in the market and that he was the original developer. And for this reason, it is not the strategy we want to pursue, although we do acknowledge it is a possibility. To quickly walk you through our assumptions, the center is currently 75% occupied, and we are underwriting getting to 95% occupancy over the course of 3 years. While this does sound like a big increase over 3 years, the market is currently 93% leased and rapidly absorbing additional space. The center was built in 2013, so it meets tenant space needs very, very well. And for this reason, we feel confident about being able to reach this 95% occupancy. All other rents, TIs, and concessions were modeled at market. So to take a step back and walk through the numbers on why we're not recommending selling this asset today, it's currently 75% leased and generating about $3.3 million in NOI. At a 6 cap, this implies a valuation of about $56 million. And after deducting for deferred maintenance and TIs and LCs and the $40 million note that sits in front of our position, we'd be looking at about $11.6 million of proceeds distributable to Oakwood in the mezzanine debt position. By executing on the business plan, however, we find ourselves in the money by the end of December 2019, and further looked at the break-even occupancy that we would need at the end of 2020 to be made whole on our entire investment, and found this to be an 85% break-even occupancy. With a 93% stabilized or 93% occupancy in the market today and a best-in-class asset, we feel really confident about being able to hit these numbers. So the left side of your screen just further exemplifies, as you would expect, that the last dollar yield is improving over time with occupancy. But to talk about the right side of your screen and Toys R Us's situation, as my colleague Raul mentioned, Toys R Us has asked for a $6 per square foot rent concession, and 15% of the existing tenancy has co-tenancy agreements related to Toys R Us. And if we were to lose Toys R Us and we were not successful in a worst case in releasing that space in 12 months, NOI would drop to $2 million today, which would imply a last dollar yield of 3.4%. In the mezzanine debt position, this is a really risky scenario to be in, and we'd need to slug and chug quite a bit of occupancy very fast in order to be able to be made whole and be able to be at stabilized debt yields to be able to get refinanced out of this loan. And therefore, we are recommending keeping Toys R Us in the space. I'm now going to turn it over to Mike, who's going to walk you through our preferred scenario.
Thanks, Alex. So as Brian discussed, the borrower came to us about a $20 million mezzanine note that we currently hold. After deliberating with the Deering Capital team, we recommend countering his proposal on 2 main points. First, the borrower has requested that the interest rate, currently set at L plus 800, be split into 2 tranches. First, an L plus 400 tranche would be paid current, and second, a 4% tranche would accrue and be paid at time of loan maturity. Given the current cash flow, we think this is an appropriate recommendation and would be amenable to it. However, we would strongly recommend that once the asset is able to maintain a 1.2 debt service coverage ratio on both the senior note and the mezzanine note at a rate of L plus 800, the mezzanine note would return to being paid current. Second, the borrower has requested an additional $6 million of mezzanine loan proceeds to cover some deferred maintenance and leasing costs. Again, we think this is an appropriate request. However, we would strongly recommend that any additional capital funded to this asset be funded as preferred equity rather than mezzanine debt and carry a rate of 12%. So as you can see from the slide, there are many benefits of preferred equity to mezzanine debt, but the one I want to talk about today is control. So as many of my colleagues have discussed, we believe in this asset, and we believe that this sponsor is the person who can get this asset back to stabilization. That said, Oakwood is in a really tenuous position where they sit in the capital stack, and so we think we need that control to ensure that the project is executed correctly. By investing as preferred equity rather than mezzanine debt, we are essentially buying ourselves a seat at that table. So taking a step back, I wanted to quickly run through the pro forma. So assuming the structure I just outlined, as well as a $20 million basis and $6 million of additional equity contribution, we would expect the returns to the Oakwood investment fund of 10.8% and a 1.3 multiple. Additionally, we really wanted to understand what would happen if Oakwood did decide to liquidate their position in Kenwood and invest in an alternative asset. To do this, we assumed that we could recover $11.6 million of their initial investment. We would have $6 million available of equity that we did not contribute to the original investment, for a total of about $17.5 million. Assuming a 9% interest rate, which is consistent with our fund return metrics, we would expect a coupon of about $1.6 million annually. By subtracting the coupon on that alternative investment from our investment in Kenwood, we'd be able to see the incremental value associated with our investment in Kenwood. And that's actually a 13.9% and a 1.4 multiple, which we think represents a very attractive risk-adjusted return for our investors. Now I'm going to hand it over to Mike, who's going to discuss next steps.
Thanks, Mike. Which is the right button to move this forward? One of our strategies is not to get invested with technology. All right. Now, as we've said, the Kenwood asset is in an excellent market, and it has strong future earning potential. The key now is to ensure that our sponsors' incentives are aligned with our fund's interests so that we can provide our investors with the downside protection that they require. Now, this issue is time sensitive, and we're prepared to negotiate with the sponsor under the following guidelines. The first is that we would not accept a deal that does not include preferred equity. We do believe that this sponsor is the best operator for this asset. However, preferred equity would provide us the control rights that we require that mezzanine debt would not, and so that we can ensure that the sponsor is able to execute on their strategy. Our target will be a 12% return on our preferred equity. If we are not able to receive this, we would request a minimum of 8%. If the sponsor refuses to provide us a preferred equity interest at a minimum of 8%, we will be foreclosing on this asset and operating with a separate sponsor. While this would provide us with a 12% IRR, as you can see at the bottom of the page, it would also require an additional $6 million of peak equity, and we would prefer to avoid the additional risks associated with transitioning sponsors at this asset. Obviously, this investment has not gone as smoothly as we'd prefer, and we think that it's important to look at the lessons we've learned here and apply them to our future investments. The first consideration we had is whether or not we believe we should still invest in retail, and that answer is a resounding yes. As Katie pointed out earlier, there's still a strong opportunity within the retail market. It's a $4.8 trillion market, and only 3.9% of that came from pure play online retailers. That leaves us 96% of $4.8 trillion to try to find some opportunities. The other risks that we wanted to consider were first, moral hazard. Obviously, in this situation, our sponsor did not leave enough skin in the game, and it will be important for us to try to avoid full cash-out lending in the future. Additionally, with the amount of disruption going on in the retail space, it will be vital for us to proactively stress test our sponsors' cash flows to try and avoid these types of DSCR issues in the future. Furthermore, our sponsors need to be more proactively reviewing their tenants' health, not only from a local perspective, but also from a nationwide perspective, to avoid the type of at-risk tenants like Toys R Us that are currently in the mall. Finally, the competition. Since the financial crisis, government regulation has led to a large expansion in the secondary lending market, which has led to decreases in prices as well as yields and a large increase in risks. It will be vital for us to stick to our strategy of market, asset, sponsor, and not allow the risks that our competitors are taking to affect the returns that our clients are receiving. Thank you very much for coming out today. Do you have any questions?
So, to fill the gander space, you recommended a couple of food retailers. Did you think about the interplay of those retailers with the Super Target?
Yeah. So Super Target we see as really complementary to this space. The food retailers that we picked, Aldi and Trader Joe's, are really destination centers. And when you really seek out to go to an Aldi or a Trader Joe's specifically for that, because at the end of the day, these have exclusive products. You can't get $2 Chuck anywhere else.
What was your thinking in not addressing the other parcels?
Yes. So on the one hand, we considered that the 12 out parcels could be used to further collateralize the loan for an additional $5 million. However, we felt that that didn't address our strategy, that this is a pure operational repositioning, and therefore we focused on preferred equity to maintain control in the driver's seat and execute that repositioning.
Thank you.
Thank you.